So we've discussed why cash is important, and the reason it's important is it's different to profit, and so many people don't understand the difference between the two. Let's look at a case study of an American company called Enron. Here's their net profits in the years leading up to the year 2000. This is in millions. So 440 million, 489, 493, bit of a blip in 97, down to 105, 98, 703, 99, 893. And $2,979. That's nearly $1 billion. You can see Enron was making profits of nearly $1 billion. And on paper, that looks very successful. It's doing a great job at generating revenue and lowering expenses to make big net profits. It's important to realize, though, that within 12 months, Enron was bankrupt. So how can that possibly happen? Well, bankrupt means you can't pay your bills. So you don't pay your bills with profit, you pay your bills with cash. Those figures there don't tell us anything about cash. It just tells us what our profit was. Another example is Lehman Brothers, a very big investment bank that went, there was a big scandal a few years ago. Let's look at its net profit leading up to 2007. And this is in millions. So we've got 1255, 975, 7800 more or less, a bit over 2, 3200, about 4,000 million, and lastly 4,192 million. So that's basically $4.2 billion of profit. And again, you look at that and you go, very successful company, massive profit. It's going to do well, and we should buy shares in it, and so on. And again, that went broke within 12 months. And how does a company that makes a profit of 4.2 billion go broke within the next 12 months? And it's all to do with cash. And basically, we need to realize that there's a difference between cash balance and profit. Cash balance is all your cash inflows, less your outflows. Profit's different. It's revenues earned, less expenses incurred. So you can get money that's not a revenue. You could go to the bank and borrow it. You could sell a non-current asset. You can make a capital contribution. And likewise, you could have an outflow that's not an expense. So, for example, you could buy a new asset, make drawings, make a loan repayment, and so on. So the cash flow statement is your cash inflows less your outflows. That'll give us what's called a net increase or decrease in cash. Income statement is revenues earned less expenses incurred equals net profit or loss. This means there'll be a difference between a cash balance and profit for the period. Let's take a very simple example. Your parents give you $100 in advance to mow the lawn 10 times in the future. So if you do the maths and divide that by 10, basically you're going to get $10 per lawn. You've already got the money though, you haven't mowed any lawns yet. You fill up your car today with $50 of fuel, and based on your car, that'll give you 500 kilometers of travel. So you've paid for the fuel, divide by 500, every kilometer will cost you 10 cents. And you pay your monthly gym membership $30, and let's say that gives you 10 sessions at the gym. So that's been paid for 30, for 10 sessions, that's $3 a session. So let's look at how cash and profit are different. So you can see on the right hand side we've got a cash flow statement where we'll calculate cash going up or down, and we've also got an income statement where we'll look at revenues earned versus expenses incurred. So on the 1st of April you got $100 to mow the lawns, you paid $50 for the fuel and you haven't traveled anywhere yet. You paid $30 for the gym membership, but you haven't been to the gym yet. So looking at cash inflows, you've received $100. You haven't paid anything, but you haven't earned any revenue either. So revenue earned is zero. You haven't mowed anyone's lawn yet. Cash outflows, you've paid $80, 50 for the fuel, 30 for the gym membership, but you haven't incurred any expenses yet. You haven't traveled anywhere. You haven't used the gym membership. So the net increase in cash will be $20. Your net profit will actually be zero. On the next day, you go and mow one lawn, and that earns you $10. You drive 50 kilometers, and that uses up $5 of fuel. And you go to the gym, and that's one gym membership or one gym session at $3. So looking at the cash flow statement, how much money came in today? Actually none. No money was received today. Did you earn it? You did, but that's different to receiving it. You've already got it. That was in the past. What about the cash outflows? The revenues earned, that'll be $10. Why? You actually mowed a lawn today, so you've earned $10. Cash outflows, how much cash left your pocket today? None. You didn't pay for fuel, you didn't pay for the gym, that was done yesterday. So all up, your cash balance is not affected at all, but your expenses, they're $8. What have you incurred? You've incurred $5 of fuel, or used up, that's another word we use for incurred, and you've incurred or used up one gym session of $3. So cash has gone up 0, but net profit will actually be $2. The next day, on the 3rd of April, you mow 3 lawns, that'll earn you 30. You drive 100 kilometers, which is $10 of fuel, and you go to the gym, and that uses up one $3 gym session. So cash inflows, how much is coming in? None. How much have you earned? $30. Cash outflows, how much cash has actually left your pocket today? None again. You haven't actually paid for fuel or the gym, that was done in the past. But expenses incurred, you've used up $10 of fuel and $3 of gym, so that's $13. That leaves a net increase of cash of nothing, but profit has gone up $17. So you can see a big difference between your cash and profit there. Looking at two businesses that are a little more complicated, a bit more like what we'll need to sort of worry about. Which business would you rather own? So you can see for each business here, we've got some things. We've got cash sales and credit sales for business A and business B. We've got receipts from debtors and payments to creditors for the two businesses. We've got a couple of expenses here. We've got the rent, which is unpaid, and the marketing, which has been paid. And then we've got two more expenses here of wages, which have been paid, and electricity, which hasn't. So looking at that, let's try and figure out which business you'd rather own. So looking at revenues, they've both got revenues of $17,000. That's the cash and credit sales. What about expenses? The expenses were the bottom 4 items for each business, and they both equal 10. So in terms of net profit, they're actually identical. So which business would you rather own? It's actually impossible to tell from the income statement. I can't tell. What I'd like to know though is how much cash have they got? So let's look at how much cash was received. So for business A, that'll be $5,000 of cash sales and $1,000 from debtors for 6. Business B, that'll be $12,000 of cash sales, but $4,000 from debtors. That's a total of 16. So business B has got a lot more money. What about paying cash? How much cash have they paid? Well, business A has paid 4, 3, and 4 for a total of 11. Business B has paid 1, 1, and 2 for a total of 4. So the cash balance of the two businesses will be quite different. Cash for business A will be negative $5,000. It's actually an overdraft. Business B, it's going to have $12,000 in the bank. So we can answer that question now. Which business would you rather be? Much rather be business B, and it's got nothing to do with their profit. Their profit is identical. But what I'm more interested in is their cash balance. So business B has much more cash than business A, and that's the business I'd rather own. So looking at that, let's say a $6,000 loan repayment was due next week. Which business would you rather be? Obviously business B. How are they going to pay it? They're simply going to pay it from the money they have in the bank. It'll come out of that number there. Business A, they don't have any money in the bank. So if they have to pay the bank back $6,000, banks always want their money. You can't not pay it. They're going to have to probably go and get another loan, which is going to make things worse. So you always want to look at cash balance because it helps us figure out how liquid or sustainable a business is. So that's